Let me tell you something that took me 60 years on Wall Street to fully appreciate, and I'm going to give it to you in the next 20 minutes for free. Most of you watching this right now are doing exactly what the financial system wants you to do. You're saving money, dutifully, carefully, responsibly, and that's precisely why most of you will never be rich. Now, before you click away, I'm not here to sell you a course. I'm not here to pitch you crypto. I'm not some 25-year-old with a rented Lamborghini pretending I made it overnight. I'm Charlie Munger. I spent decades sitting next to Warren Buffett, building Berkshire Hathaway from nothing into one of the most valuable companies in the history of human civilization. And I can tell you with absolute certainty, the single greatest financial mistake ordinary people make is confusing the feeling of safety with actual financial progress. Saving money in a bank account feels safe. It feels responsible. It feels like control. It is none of those things. Stick with me. Because what I'm about to walk you through isn't theory. It's the framework that separates people who accumulate wealth from people who just accumulate years of working for someone else. I want you to think back to when you were a child. Your parents, good, well-meaning people, sat you down and told you, save your money, don't spend it on nonsense, put it in the bank and it'll grow. School reinforced it. Television reinforced it. Every institution you ever trusted reinforced it. Now I want to ask you a simple question. Who benefits most from that advice? Not you. The bank. Here's something most financial educators are too polite to say plainly, so I'll say it plainly. Because I've never had much patience for politeness when precision is available. The modern banking system is a beautiful piece of engineering designed to use your capital to generate their profits while paying you just enough interest to keep you from complaining. Let me give you the mechanics. You deposit $10,000 into a savings account. The bank thanks you, gives you 0.5% interest. Maybe 4 or 5% if you're lucky in a high-rate environment, and then turns around and lends that same money out at 7%, 9%, 15%, sometimes 24% on credit cards. They keep the spread. You keep the illusion of growth. Now, historically, going back further than most people bother to look, money actually meant something concrete. In the era of the gold standard, a dollar was a claim on a fixed amount of gold. You could walk into a bank and demand it. That constraint forced discipline on governments. It forced discipline on spending. But in 1933, that anchor was cut loose. And in 1971, Nixon ended the last remnant of gold convertibility entirely. From that moment forward, the dollar became what economists call fiat currency, money by government decree, backed by nothing except collective faith and the United States military. I'm not telling you this to be conspiratorial. I'm telling you this because understanding the nature of money is the first and most overlooked step to managing it intelligently. When money is no longer tethered to anything real, governments can create more of it whenever it becomes politically convenient. And that, my friends, is where your savings begin to die. Inflation is the most cunning tax ever invented because it's the only tax nobody voted for, nobody approved, and most people don't even realize they're paying it. Let me make this viscerally real for you. In 1970, a new car cost about $3,500. A house in a decent American suburb, $23,000. A year of college tuition, under $400. Today, a car is $48,000. A house is $400,000. A year of tuition is $35,000. Now here's the question nobody asks. Did those things genuinely become more valuable? Did a house suddenly start doing more for you than it did in 1970? No. What happened is that the dollar became worth less. Not worthless yet, but substantially, measurably, relentlessly less valuable. And here's the brutal arithmetic that should keep every saver up at night. The reported inflation rate in the United States has hovered around 3 to 4% in recent years. Some economists, myself included, believe the actual erosion of purchasing power runs considerably higher when you account for housing, healthcare, and education costs, which are conveniently weighted out of certain official calculations. But even accepting the official 3.5% figure, your savings account paying 0.5% interest is losing your real purchasing power at a rate of 3% per year. You're not saving. You're melting. Put $100,000 in the bank account today. Do nothing with it. Feel safe. Pat yourself on the back. In 20 years, that $100,000 will have the purchasing power of roughly $50,000 in today's terms. Half your wealth gone, not to a bad investment, not to a stock market crash, gone to doing nothing. This is the trap. This is the great irony of cautious money management, that the most dangerous thing you can do with money is leave it completely still. There are three forces eating your savings simultaneously, and understanding them is not optional. It's survival. The first is demand-pull inflation. When too many dollars chase too few goods. We saw this dramatically during and after the pandemic. Supply chains broke. People still had money. Prices exploded. The second is cost-push inflation. When the cost of producing things rises and those costs get passed to you. I've watched this happen in real estate, in energy, in agriculture. The builder pays more, so you pay more. Simple and inescapable. The third, and this is the one that should concern you most, is monetary expansion. When governments print money at a rate that outpaces the production of actual goods and services, each existing dollar buys less. During 2020 and 2021, the United States added more dollars to circulation than in its entire prior history. More than 40% of all U.S. dollars in existence were created in a 24-month window. If you understand basic supply and demand, you understand what that does to the purchasing power of every dollar you carefully saved. And yet the savings account kept ticking along at 0.06%. I've always said that the first rule of compounding is to never interrupt it unnecessarily. Well, the first rule of protecting wealth is to never let inflation interrupt it uncontested. Now I want to address something that I find more interesting than the economics, and that's the psychology. Because here's what confuses me about intelligent people and money. They apply rigorous logic to almost every decision in their lives, and then completely abandon that logic when it comes to their savings. Why? I think there are three psychological forces at work that almost nobody talks about honestly. The first is what I call the security illusion. Seeing a large number in your bank account creates a neurological feeling of safety. It doesn't matter that the number is slowly shrinking in real terms. The number going up, even marginally, satisfies some primal part of the human brain that says, I am protected. This is the same cognitive bias that makes people hold on to losing stocks for too long. The feeling of not having lost is more powerful than the reality that you have. The second force is loss aversion. Kahneman and Tversky, brilliant psychologists, demonstrated that humans feel the pain of losing $100 roughly twice as intensely as they feel the pleasure of gaining $100. This asymmetry in emotional experience makes people irrationally risk-averse. They would rather accept a certain small loss via inflation than risk a potential larger loss in the market. But here's the irony. Inflation is the certain loss. It's just invisible. You never get a statement from your bank saying, inflation ate $3,200 of your wealth this year. You just notice gradually that things cost more. The frog in the slowly boiling water. The third force is what Charlie Darwin might call cognitive inertia. People keep doing what they've always done because changing requires effort, attention, and accepting that what you were doing before was wrong. Most people would rather be comfortable and wrong than uncomfortable and right. I watched this my entire career. Brilliant people. Harvard-educated people. People who could calculate compound interest in their heads, making the same elementary mistake with their personal finances that they would never tolerate in a business decision. Now, here's what I want to be very clear about. Because I don't believe in tearing things down without building something better in their place. I'm not saying don't have savings. That would be reckless advice. An emergency fund, 3 to 6 months of living expenses, is not optional. It is the foundation. Without it, you become a forced seller at the worst possible time. A medical emergency, a job loss, a car breakdown, and suddenly you're liquidating investments at a market bottom because you have no cushion. That emergency fund should sit somewhere accessible. A high-yield savings account or a money market fund, which invests in short-term, high-quality government and corporate debt, will give you better interest than a traditional savings account while keeping your money liquid. But beyond that emergency cushion, that money needs to go to work aggressively, intelligently, and immediately. I've spent my life studying businesses, reading financial statements, and thinking about what actually creates and compounds wealth over time. Let me give you the clearest framework I know. Rule number one, you cannot save your way to wealth. You can only invest your way there. Savings preserve, investing multiplies. These are categorically different activities with categorically different outcomes. You need both, but most people massively overallocate to the former. Rule number two, time is the engine, not money. The most valuable asset any young person has isn't their income. It isn't their savings. It's their runway, the number of years they have available for compound interest to work. Here's a number that should tattoo itself into your memory. $1 invested at age 25 at a 10% annual return becomes $73 by age $65.1. Invested at age 45 at the same rate becomes $6.70. Same dollar, same return, different outcome by a factor of 12, purely because of time. This is why I become mildly furious when young people tell me they're waiting until things settle down before they start investing. Settling down costs you. Every year you wait is not a neutral decision. It is an active, expensive choice. Rule number three. The market's long-term record is not a matter of opinion. Over any 20-year period in the history of the S&P 500, the index has been positive. Over most 10-year periods, it's been positive. The average annualized return over the past century has been approximately 10% before inflation, or roughly 7% after adjusting for inflation. Could the next 100 years look different? Theoretically, but betting against the long-term productive capacity of American business is a bet I've never been willing to make. For most people, and I mean this sincerely, the optimal strategy is boringly simple. Buy a low-cost index fund tracking the S&P 500. Contribute regularly, reinvest dividends, and do not touch it. This is not exciting advice. It does not require a Bloomberg terminal. It does not require you to understand quarterly earnings calls or parse central bank minutes. But it works, and it works because it harnesses the two most powerful forces in finance: diversification and compound interest. Now, for those of you who want to be more active, who want to actually study businesses and build a genuine understanding of value, I respect that ambition, but I'll tell you exactly what I look for. I look for businesses with what we call a moat, a durable competitive advantage that protects their earnings from competition, a brand so strong that customers won't switch, a network effect so powerful that the product becomes more valuable as more people use it, a cost advantage so significant that competitors can't profitably undercut them. I look for businesses run by honest, competent people who own significant stock in their own company, management that eats its own cooking. I look for businesses I can understand, because I've never bought a business I couldn't understand, and I've never regretted that discipline. And I look for a price that's reasonable, ideally a significant discount to my estimate of intrinsic value. Because, as my partner Warren says, price is what you pay, value is what you get. Most people will never develop this level of analytical skill, and they don't need to. The index fund does the work for you. But for those who want to go deeper, that framework is where to start. I want to spend a moment on something that frustrates me about the financial advice landscape, including, candidly, a lot of content you'll find online. Most financial advice tells you what to do. Very little of it tells you why, and even less of it tells you what not to do. In my experience, inversion is one of the most powerful thinking tools available. Instead of asking, "How do I get rich?" ask, "What are all the ways people destroy wealth?" And then simply don't do those things. Let me give you the most common wealth destroyers I've observed over 6 decades. The first is lifestyle inflation. As income rises, spending rises proportionally, or faster. The person who couldn't afford a BMW on a $60,000 salary somehow feels they need one on the $120,000 salary. The house gets bigger. The vacations get more expensive. The clothing brands shift. Lifestyle inflation is insidious because it feels like progress. You're rewarding your success, but you're doing the opposite. You're eliminating the surplus capital that would compound into actual independence. The wealthy people I know, genuinely wealthy, not performatively wealthy, almost universally live below their means. Not because they can't afford more, because they understand that every dollar spent on consumption is a dollar not compounding toward freedom. The second wealth destroyer is fees. This is something most investors, even sophisticated ones, dramatically underestimate. A 1% annual fee on a portfolio sounds trivial. Over 30 years on a $100,000 portfolio earning 8% annually, that 1% fee costs you approximately $143,000 in foregone compounding. That's not a rounding error. That's a significant portion of your retirement. Index funds from reputable providers charge as little as 0.03% to 0.10% annually. Actively managed funds frequently charge 1% or more, and the overwhelming academic evidence shows they do not outperform the index after fees over long time periods. Pay attention to fees. They are the silent killers of compound interest. The third wealth destroyer is panic. And this is the one that gets otherwise intelligent people at the worst possible moment. Markets fall. This is not a possibility, this is a certainty. Markets have always fallen and they have always recovered. But every single time the market drops 20 or 30%, the financial news becomes apocalyptic. Experts predict a new depression. Ordinary investors sell, locking in permanent losses, and wait for stability before re-entering, typically missing most of the recovery. The people who built wealth in the market are not the people who timed it perfectly. They are the people who stayed in it imperfectly, who kept contributing through crashes, who didn't check their portfolios every morning, who understood that volatility is the price of admission for long-term return. If you cannot psychologically tolerate a 30% drop in your portfolio value without selling, you need to adjust your asset allocation, not your investing philosophy. The fourth wealth destroyer, and I'll name it directly, is financial ignorance passed off as caution. I've met people who are genuinely afraid of the stock market, who think investing is gambling, but believe the only safe place for money is a savings account or government bonds. This is not caution. This is a lack of understanding that has been rationalized into a virtue. The market is not a casino. A casino is a zero-sum game. One person's gain is another's loss. The stock market is ownership in real businesses that produce real goods and services consumed by real people. Over time, those businesses grow, and as an owner, even of a fractional share, you participate in that growth. Understanding this distinction is not optional if you want to build wealth. It is the foundation on which everything else rests. There's a concept in economics called opportunity cost. It means the cost of not doing something, the value of the best alternative you gave up. Most people calculate the risks of investing. Almost nobody calculates the opportunity cost of not investing. Let me do that calculation for you right now. And I want you to sit with it because this is where theory becomes uncomfortable reality. The average American holds a significant portion of their savings in cash or near cash instruments. Let's be generous and say they're earning 4% on that money, which is better than historical averages. Now compare that to the S&P 500's historical average of 10%. On $50,000 over 30 years, at 4%, you accumulate approximately $162,000. At 10%, you accumulate approximately $872,000. The cost of choosing the savings account over the index fund, $710,000. Not because the savings account lost money. It didn't. It grew. But it grew so much slower that you left $710,000 on the table. That's the opportunity cost. That's what caution actually costs you over a lifetime, and this is before we account for inflation, which erodes the real value of that $162,000 further. This is why I've always said that the greatest financial risk most people take is not the risk they fear, a market crash, a bad investment, but the risk they embrace without knowing it, the slow, invisible destruction of their purchasing power through inaction. I want to close with something that I consider more important than any specific investment advice I could give you. It's a mindset, a fundamental reorientation in how you think about money. Most people think of money as the goal, as the thing to be accumulated and protected, as a measure of success and security. This is precisely backwards. Money is a tool. Capital is a resource. And like any tool, its value is entirely determined by how effectively you deploy it. A hammer sitting in a toolbox has no value. Its value emerges only when it's used to build something. Money is the same. Sitting in a savings account, it is a hammer in a toolbox, slowly rusting. The fundamental shift is this. Stop thinking about money as something to have and start thinking about it as something to put to work. Every dollar you hold is a capital allocation decision. When you leave it in a 0.5% savings account, you've made a decision. Just a passive, thoughtless one. When you invest it in a productive asset, you've made an active, intentional decision. The wealthy don't have more willpower. They're not smarter. They don't work harder. In most cases, they just make different decisions with their capital. Consistently, patiently, over long periods of time. And here's what I want you to understand about starting today versus starting tomorrow. The market doesn't care when you start. It doesn't reward the people who timed it perfectly. It rewards the people who started, who put their capital to work, who harnessed compound interest, and who had the patience to let time do what time does. There's a saying I've always liked, adapted from an old Chinese proverb. The best time to plant a tree was 20 years ago. The second best time is today. If you're 22 years old watching this, you have an advantage. I would trade significant sums to possess time. Do not squander it on the comfort of a savings account that slowly converts your future into the bank's present. If you're 45 years old watching this, you have less runway, but you have something else, a higher income, presumably, and the wisdom to know that another decade of waiting is a decade you cannot afford. If you're 65 watching this, even now, even at this stage, the decisions you make about the next 20 years of your capital matter. People live longer than they think. A 65-year-old today has a meaningful statistical probability of living to 90. That's 25 years for compound interest to work. There is no age at which this stops mattering. The conclusion I want you to leave with is simple, and I want to say it plainly because I think it deserves plainness. Your savings account is not protecting you. It is slowly failing you. The financial system was designed to extract profit from your passivity. The antidote to that passivity is understanding. Understanding what money actually is, what inflation actually does, what markets actually represent, and what compound interest actually accomplishes when given time and discipline. You don't need to be a genius. You don't need an MBA. You don't need a financial advisor charging you 1% of your assets annually to tell you things you could learn yourself in 40 hours of reading. You need 3 things: an emergency fund, 3 to 6 months of expenses, liquid, accessible, a consistent investment habit, index funds, low costs, regular contributions, long time horizon, and the psychological fortitude to leave it alone when markets terrify you, because they will, regularly, by design. That's it. That's the framework. Everything else is noise. I've watched a lot of people make a lot of money and lose a lot of money over 60 years. The ones who built genuine, lasting wealth were almost never the ones who found a clever shortcut. They were the ones who understood the rules of the game, really understood them, and then played patiently for a very long time. I hope you'll be one of them. Now go make your money work harder than you do. If anything in this conversation shifted the way you think about your money, even slightly, then share it with someone you care about. Financial literacy is not widely taught, and the people who most need this understanding are often the ones least likely to find it. The next video coming up covers exactly how to begin investing if you've never done it before, the specific mechanics, the psychological traps to avoid, and the most common mistakes new investors make in their first 2 years. Don't miss it.